Hi there, welcome to Kneppy Invest and welcome to August the 12th, 2024. We have about 2 hours left of trading time. Currently is 2:06 p.m. And overall, pretty good day on the markets, apart from maybe mining companies. Results down 0.47%. We have seen quite a few interesting full-year results released today, including JB Hi-Fi. I did a tweet on this. I think I mentioned that over the past few months, quite a few of the panelists on Ausbiz the Call have called JB Hi-Fi a sell because of tail or not tailwinds, headwinds, those sort of things. And it just shows you sometimes the experts can be completely wrong because last time I looked, JB Hi-Fi was up about 8.5% on the back of their results, on the back of a pretty good start to the financial year, on the back of another acquisition, and the share price now is an all-time high. So that company has come in number one on my top 5 stocks of the day. So I've already given that away. Few other interesting results from Car Group, Aurizon, Beach Petroleum, a few REITs, which I might talk about very briefly. We also saw some phase 2 results from Actinogen. Share price of that company down about 60%. And also, interesting announcement from St. George Mining. I think that's what it's called. St. George Mining, yeah. Share price up 36%. I thought that announcement was interesting from some false rumors from social media. And a company called, have never had a look at this company before. A company called WT Financial Group released some sort of announcement, indicative results. Share price up 12.7%. Market cap of this company is really low, like 24 million. And I had a look at the results. Then I had a look at the market cap and went, geez, why have I never heard of this company before? And maybe the reason I've never heard of this company before is because of the chart. So I'll have a look at WT Financial Group as well. Maybe a few tweets. We'll also have a look at the best and worst performing sectors, indices, and companies, and then maybe a few charts or maybe a few of your comments. So let's get stuck into it. Starting off with a few tweets. This is from Warren Pies. So what happens when the S&P 500 corrects by 10% and the Fed cuts within the next 3 months? Well, a little bit of pain within the following 2 or 3 months, and then good times for the rest of the year. In fact, return over the next 12 months equals about 14%. So a nice little chart from Warren Pies. And this sort of thing is interesting because I have heard of, or did read a few other tweets. I think it was from Rudy saying that when the Fed cuts, it's good times. The stock market goes up. So it's all about what time period you're looking at. If you're thinking just the next 3 months, we could be seeing the markets down a little bit. But if you're thinking the next 12 months, next 2 years, more than likely the markets are going to be up. And one from a bar chart, sort of saying the same thing, but getting to a different result. So talking about 250 days out from when the Fed cuts. So there are many people cheering for Fed cuts, but it all boils down to whether we get a recession. Not us in Australia, but United States. If we don't, stocks are likely to go off to the races. But if we do, look out below. So that is also very important. So the one for Warren Pies didn't really take that into account. And it is important. If we do go in recession, I think there could be significant pain. And also depends on what type of recession. If it's a very weak recession, maybe not as much pain. But if it's a steep, severe recession, who knows? Any other tweets here? Oh, just a bar chart, Fibonacci trading cheat sheet. Well, I want to learn Fibonacci. A few other things about trading I want to learn because Fibonacci, there's heaps of Fibonacci in nature. Nature is just full of Fibonacci. So if nature loves Fibonacci, then why not trading or technical analysis? Okay, that's a few tweets I want to talk about. Let's have a look at the ASX today. Yeah, pretty good day in the markets. Tech up 1.5%. Resources down. So I'd assume materials and energy are down. Yep. Energy down 0.22%, materials down 0.47%, and IT, the best performing sector, discretionary not far behind, telecommunications, Telstra's probably had a good day, financials and healthcare, all above 0.5%. Don't really have to go into the indices, so we'll just go to the ASX 20. up 0.48%. I have a little bit of a guess here. With energy materials down, I would sort of assume that, and I have no idea what's happened to with iron ore. So I'm going to assume maybe BHP, Rio Tinto, Fortescue, or all lower. Maybe Santos, Woodside are lower as well. Well, WiseTech probably had the best day. I'm going to call it no WiseTech. WiseTech, yeah, I'm going to say WiseTech's had the best day today. Okay, so let's have in the ASX 20, not overall. So let's have a look at the ASX 20 and let's see how many companies are up and down. I'm going to say 14 companies up, 6 down. Close. And those companies down are REA Group. There you go. So Rio Tinto, Fortescue, Santos, BHP, all down. So no surprises there. Coles and Woolworths Group. Both of those are staples. So I would expect Staples to have had a bad day, but it wasn't down. So what were the best performing companies today? There's WiseTech coming in at number 1 and Aristocrat just behind WiseTech. So no surprise there at all. I'm just going to go back to have a look at Staples. Staples up 0.3%. What else is in Staples to have driven that particular sector up? Let's have a look. So by market cap, Woolworths and Coles by far the biggest companies in that sector. And just behind those two companies, we have Treasury Wine and Endeavour Group. Both of those companies are up, particularly Treasury Wines. GrainCorp is up a fair bit. Ingham's Group, Bega Cheese up as well. So overall, a good day for consumer staples apart from the two biggest companies in that sector, although Woolworths is only down 0.3%. Okay, so let's have a look at the best and worst performing companies today. I'm assuming St. George Mining is in there, and I am assuming Actinogen is a worst performing company. So let's have a look at the best performing companies today. And there is St. George Mining, the best performed company on the ASX today, up 32%. Now that's in market index. That's a little bit delayed. And if we go straight to this GQ, up 36%. So this was, now the share price of this company has been highly volatile the last few trading days, up 21% on the 6th, down 39% on the 7th. I believe on the 6th it was recommended by Next Investors. I believe that's so. Then the company went into trading halt and they've just announced an update to their Ruxa high-grade niobium project. So I haven't really been following this company at all. So they did make an acquisition of that project on the 6th of August. So that really helped the share price going hot on that particular day. And then the share price fell the next day. Anyway, this was actually a really interesting update because of what they're sort of implying. So they've just mentioned here, they wanted to provide an update on this proposed acquisition. And then they go on. The company is aware of misinformation circulating in online chat rooms and social media regarding Araxa. Now, I don't really go to Hot Copper all that much. So I would say, and maybe not falsely, but I would assume, possibly wrongly, that a lot of that misinformation is on Hot Copper because who knows what you're going to get in Hot Copper. It is an insane asylum at times. And this particular misleading information, particularly claiming that an active tailings dam is located within the project area and that significant high-grade mineralization discovered at the project is beneath the tailings dam. This information is false and not correct. There you go. Now, it seems like this misinformation was good for the company in terms of it would have made the project even better. But this market reaction is the complete opposite way, up 36%. Now in saying that, the volatility in the share price has been quite extreme. So this could be just day traders today. And if you have a look at the chart, you can just see that in the chart for SGQ. And yeah, it's all over the place the last few days. All over the place. Yeah, there's actually no trend in the chart at all. So I just found the announcement interesting. That's about it. That there's misinformation on Hot Copper? Never. If it's not Hot Copper, sorry to Hot Copper. Anyway, I try to stay away from Hot Copper as much as I can. One of the only times I do have a look at Hot Copper, HighCom is up 27.3%. Go HighCom. One of the only reasons I go to have a look at Hot Copper is I go to see if a company I do like is heavily discussed, and if it is, that I'm a little bit more wary. But if there's no comments, nothing on a company I like, that's actually a pretty good sign. Anyway, back to the top gainers, Highcom. Maybe I should have taken a trading position or added to my trading position in Highcom, although I do have a fair bit in Highcom. I had a look earlier today, and the value of my position in Highcom is now up to 3,000. So it's more than doubled in the past week. So another increase of 27.3%. So a lot of enthusiasm coming in for Highcom, and that's understandable. I did think at one point the share price or the valuation of the company was getting way too low. And it just share price was going sideways for a long time, and share price has just taken off. It has doubled, more than doubled in the past week and a bit. Anyway, back to the top gainers. Anything else here of interest? You might say, well, what about that company, DY6 Metals? I like that company. I don't care. Or maybe LTR Pharma. No, I'm thinking about companies that have released an announcement today, like Bass Oil. They released something today, but it's on fairly low turnover. So move on. And there is WT Financial Group, up 12.7%. So let's talk about it now. Yeah, why not? And one of the reasons why I haven't really been following this company and haven't really noticed this company is just the chart. The chart is just so not interesting. It is liquidly traded, and over time it's been going down. And then I had a look at the markup of the company. So WT Financial Group has a markup of $27 million. So it's a little bit higher than it was because it's risen 12.7%. And then I had a look at this announcement. I went, what was the ticker? WTL. So they released this particular announcement, and it did say the share price was up. That's the whole reason I was actually drawn to this announcement, because the share price was up. They released at 11:53 a.m. So I initially missed it. And then when I came back to my computer to start preparing for this video, and a lot of times when I start preparing for these videos, my preparation time can be 5 seconds. So I just wanted to have a look at some of the announcements that were released after 10 a.m. And I saw this. This is sort of announcement I will always look at. I opened it up and I went, this is actually really interesting. So WT Financial, and I'm assuming they're a financial services type company. In fact, so let's have a look at their about section. Largest financial advisor network in Australia, or has established itself as amongst the very largest. You don't need the word very in there. I would know some writers who would get very upset using the word very. Anyway, it's wealth management, retirement planning, and personal risk insurance advice services are delivered primarily through a group of around 400 privately owned advice practices, whose advisors operate as authorized representatives under its Wealth Today, Century Advice, Synchron Advice, and Millennium 3 subsidiaries. The group's B2C, business to consumer division, delivers a range of financial advice services. So sort of what I thought, a financial services type company. And it seems like there's many of these type of companies on the ASX. So more than likely this company doesn't have any sort of mode, but that could be good value. So remember, the markup of this company is 27 million. Now, this is just their indicative results. So they only provide us with revenue, EBIT, profit before tax. Do they even give us profit after tax? No. Cash also. Nice commentary as well. So let's go through this fairly quickly. Revenue of $185 million, which was a nice 15.3% increase on last year. Gross profit increasing 17.4% to $17.7 million. EBIT up 41.5% to $5.2 million. Profit before tax up to $4.4 million, which means I suppose their profit after tax wouldn't be that much lower, maybe 3 to 4 billion in that range, which means a P ratio of this company, even after the rise today, is probably about 6 to 9. 6 to 9. In fact, let's have a look at TradingView. So I want to see what the markup of the P ratio is. It says 5.92 at a markup of 24 million. And if you go through the last few years, substantial rise in revenue over the last 3 years, and profit has doubled. In fact, profit doubled from financial year 22 to financial year 23. It was negative financial year 21. I am going to have a closer look at this company because it seems like this company is growing. It's not my favorite type of company, put it that way, but there could be value here. Let's go back to this particular announcement. Also, a dividend. Have they issued dividend before? Sometimes if a company issues their inaugural dividend, that could be a good sign. No. Well, yeah. So last time, according to this, last time they had a dividend was 2017. Okay. So this could be an interesting little company. I'm going to go through this in finer detail. Yeah, let's have a look at the commentary here. So we've seen compounding growth in underlying net profit before tax above 50% for 4 straight years now. So yeah, that's interesting. More broadly, our results are not only reflective of our network's performance, but of a positive future for all advice practices and advice networks operators who embrace and drive change. So there's a possibility that the market is completely missing this company. And I have heard of this company before, but I've never had a look at it. So possibly today could be the catalyst for me taking a look. So I think I said I've never heard of this company before, but I think I have. I've heard of most companies like this, but I've never had a look at it. That's the most important thing. Never had a look at it. And I think maybe now is time to have a look at WT Financial. A few other companies. No, actually, go back to the top performance because that's why I veered off into the WT Financial Group discussion. Anything else there? No. Let's have a look by market cap. JB Hi-Fi up 8.7%. Westgold Resources, Data, Bellevue Gold's had a really nice bounce. I thought that company looked really cheap. Well, good, maybe not cheap, but the company had fallen. The share price had fallen into a support zone for Bellevue Gold. And the share price has bounced. In fact, the share price has bounced the last 2 days. But again, share price of this company will move with gold. If gold has a couple of really bad days, share price of this company could plunge. So I'm not the biggest fan of mining companies because I just don't know which way the underlying commodity is going to go. And a lot of these other companies here have had bounces like Cettire. Qoria's had a bit of a bounce. Race Oncology bounce. Avita Medical, another good day. They released their results last week. I think it was last Friday. A really good day on Friday, and that day has followed on today. So Avita, AVH, up to $3? Nearly $3, not quite a breakout, but it's all over the place. I think I talked about this company on Friday's video. So let's move on. Titomic, another good day. FBR, I know there are some viewers of this channel who do like that company, up 8.6%. Okay, so let's have a look at the worst performing companies on the ASX. And I'm pretty sure Actinogen will be number 1. There it is, Actinogen number 1. I'll talk about that company a little bit later on because that company is in my top 5 stocks, down at 60.5%. I wouldn't be, it's a bad day for shareholders, but I wouldn't be absolutely distraught and upset. And I'll tell you why when I talk about Actinogen later in the video. Otherwise, there's a lot of crap companies here. Oliver's Real Food, Ventura Health, down 18.4%. I wonder if that company released anything today. Let's have a look, see. What's today's date? No, it's just noise, I suppose, at this point. And that's it. A lot of small, crappy companies on this list. Oh, except Beach Energy. There it is, down the bottom, down 11.4%. Wasn't going to include Beach Energy into my top 5 stocks of the day, but when the share price is down 11% on the release of their results, I just have to include it. So Beach Energy comes in at number 5, which pushes out another company, and that other company would have been one of those REITs, which I'll talk about in a few minutes, I think, or maybe even more than a few minutes. So let's have a look by market cap. There's Aurizon, down 8%. I really want to discuss Aurizon coming in number 4, and I almost put in a buy for Aurizon before I started recording this video. I'll tell you why I almost put a buy bid in for that company. Otherwise, Vita Life Sciences, a few viewers do like that company, down 7.8%. Probably just noise, I'm assuming, because turnover is fairly low. That is a problem with low turnover companies or low liquidity companies, is the share price can rise or fall by a fair bit. You just got to hold your nerve. You're in it for a reason, more than likely. Money Me down 9%. Share price tried to get above 10 cents recently, and now it's back down to 8 cents. I'm just going to have a really close look at Money Me. I did have this company on my watch lists in case it was breaking out. And now this is, you can just see here how important round numbers is. And in my opinion, 10 cents is probably one of the most important numbers. One of the reasons why 10 cents is really important is because the share price of a company can go up and down different increments. So below 10 cents, it's every zero point 0.1 cents. Above 10 cents, it's every 0.5 cents. And I have seen time and time again over the last 15 years, 10 cents is a natural resistance and support level. And you can see that with MoneyMe in 2024. It tried to get above 10 cents in January in 4 consecutive days, actually 4 out of 5 days. Share price went to 10.5 cents and then fell back below 10 cents. So we saw a lot of selling in MoneyMe, and then share price fell below 10 cents, not permanently, but for a while. And then a good result or something good happened on the 2nd of August, which was over 10 days now. Share price went to 10.5 cents again and has pulled back now to 8 cents. So that just really highlights that 10 cents is very important for this company. And when the share price breaks above 10 cents, if it breaks above 10 cents, that would be fairly significant for this company. That's one of the reasons I put this company on my watch list. I just want to see if it could break above 10 cents. But the share price has dropped another 9% today. Piedmont Lithium. They did release something recently, but I don't really care. It's lithium. All right, so that's the best and worst performing companies on the ASX. Now, before we get the top 5 stocks of the day, I just wanted to just have a quick look at 2 REITs that released their results today. Healthco Healthcare and Wellness, and the other one was Dexus Convenience Retail. I actually don't mind these companies. So Healthco Healthcare and Wellness REIT. So share price $1.19. You can see a dividend relatively flat. So you're not going to get much growth in terms of dividend, that sort of thing, unless we see a significant revaluation in their property, maybe. I don't know. Or that's got more in line with capital growth. Dividend yield's okay. So let's have a look at why I don't necessarily mind this company. Now, I had a look at the presentation, not their media release, but hopefully there'll be a little bit of interesting information. So this company, I would assume where their assets are, it's fairly safe and defensive. We're talking about hospitals and governments. So I would say that's fairly safe and defensive. Now, one of the things I do look at is FFO. So and DPU. So FFO and DPU should be fairly similar. So funds from operation is FFO. DPU, I'm pretty sure that's distribution per unit. So it's like a dividend. And a lot of times you will see those 2 metrics, or whatever you want to call them, almost identical. That means 100% payout ratio if they are identical. It's 8 cents, which means what if that's a full year? If it's a full year, the dividend yield's not that bad. Gearing 32.5%. One thing I have noticed looking at these REITs over the past few weeks, a lot of the gearing of these REITs are between 25 and 35%. So they have a target range of between 30 and 40%. So 32.5%. Net tangible assets, $1.64. So this is where it becomes interesting. $1.64, and the current share price is $1.19. So significantly below the net tangible assets. So there's a bit of a discount. There might be reasons behind that. And they also gave some guidance, and they've actually increased their DPU and FFO. So that is interesting in itself. So I actually don't mind this particular company. I had a look at the presentation. I do like their assets. Have a look at the chart. The chart, most REITs, I actually haven't had a look at the chart, so I'm just guessing here. So we can confirm that. Yeah, most charts or REITs charts don't look that good. But I'm wondering if now is a time to start getting interested in these sort of companies. Now, the share price of this company has fallen since it IPO'd. It's fallen from $2.38 to $1.19. So it's actually halved in the past 3 years. I think there could be some value in this. And I could imagine you might be able to get some nice capital growth in this type of REIT, and also a nice dividend yield. I wouldn't be surprised to see a 30 to 40% return in your capital over the next few years, plus, on top of that, a nice dividend. And the other one was Dexus Convenience. I don't mind this one either. This was actually the very first REIT I ever looked at about 2 years ago, and I'm pretty sure the share price is actually lower now. And one of the reasons I just want to see because I knew all these companies, all these REITs were trading below NTA. And I thought, is now the time to buy some of these REITs? That was 2 years ago. And if I was too early, that would have been a mistake. Now, this is a company that owns like service stations. So, what do you call them? Those major road service stops. I forget what they call them. You know what I mean? When you're driving 6 hours and you need petrol or you need something to eat and it's on the side of the road on like a major highway, service stations, whatever they want to call them. So that's mainly what they do. So funds from operation and distributions of 21 cents per security. So let's have a look at share price. So pretty nice dividend as well. Increased like-for-like net property income growth to 2.8%, gearing of 32.9%, fairly similar to most other REITs. You also want to have a look at WALE, which is the weighted average length lease expiry or something like that. Do they mention that here? It's probably fairly long. I'd say most of their investments are pretty, or most of their property or assets are pretty safe as well, unless we get teleportation and then all their assets become useless. Do they have an outlook? Provides financially 25 guidance for FFO and distributions of 20.6, reflecting an attractive distribution yield of 7.3%. So 20.6, is that an increase from this year? Where is it? Nice, a slight decrease. So maybe the other one, the healthcare one, is a little bit better because they are expecting or forecasting an increase in the distribution. So Dex's convenience retail, I do like the dividend. And also the chart probably looks just like most of the other REITs, looks pretty, oh, that's the wrong, this is some sort of Italian company, DXC. And the chart, oh, if you look at the daily chart, the share price of this company rose 8% on Monday last week. That was interesting. Oh, that's the weekly chart. Wrong chart. In fact, the daily chart doesn't look that bad. Actually, this doesn't look half bad, this one. I probably would prefer the other one, but look at that. You could have bought this company at $2.20. That's a dividend yield of 10%. That was in October last year. That was near the bottom. Anyway, so that's the two REITs I just want to discuss fairly quickly. As I have had a look at more REITs, I actually don't mind this space, particularly for the right REIT, particularly if it's attractively valued with a nice little dividend yield. I could actually expect some nice returns from those sort of companies. Okay, so let's get to the top 5 stocks of the day. Coming in number 5, I didn't have a really good look at this company, Beach Energy, but the share price is down 12.8%. So obviously these results are not to the market's liking. We know that. So they released their results, 4 pages, their annual report, 156 pages, their presentation, 31 pages, a corporate government statement. I've never opened one of those up, 20 pages, an Appendix 4G. Actually, I don't know what that is, 13 pages, an Appendix 4E, 2 pages, and a dividend distribution, 4 pages. So the main things I like to look at are financial statements, media, and presentation. A lot of times I'll just look at the presentation because I can be quite lazy. So let's do that because this is the one I looked at really quickly. And the main thing I took away from Beach Energy was down. Seems like everything is down. I think something was up, like maybe the production was up, but everything else is down. And this, again, is the sort of company I would not buy for the long term. I don't care. I don't care if they might have significant growth in the future. It's all because the performance of this company is ultimately going to be highly correlated to the price of the underlying commodity they are mining. For this company, it's gas. I'm assuming it's gas, energy for a gas-supported transition. Anyways, Beach Energy. They're trying to talk about how or why you should invest in the company. Value proposition. Well, if they were good value before today, they're really good value now. Talking about key milestones, financial results. I remember back in 2016, and the reason I say that is because I know that was the bottom of the mining cycle. If you look at financial results back then, the first thing mining companies would talk about is health. No, we had no injuries for the year. Hooray. And then they go into financial results. Anyway, so always highlight the positive things before you get into the negative things. So you always want to see the financial results at the front page, at the first thing you see, because that's a good sign the results are pretty good. So this is the headline results, solid results. They say they're solid results as major projects near completion, but production down. What was up? And sales revenue up, underlying EBITDA down, dividend no change. There is the health bit. Sustainability, don't care about that. Here we go, financial results. I think this is what I was looking at. Okay, so production down or sales volume that was up. I was wondering why is production down but sales volume up? I would have thought they would be fairly similar. That just shows you that sometimes I am not the biggest expert in these sort of companies. Sales revenue up, average realized oil price is up a little bit, but that is something they can't control, is it? Average realized gas ethane price up as well. So that should be positive for the company. But underlying EBITDA down, underlying EBITDA margin down by 7 basis points. That's a fairly big drop. Underlying profit, because margins down 11%. Operating cash flow down 17%. Pre-growth free cash flow down at 26%. Dividends paid up 33%. Net debt up 251%. That could be because of projects, that sort of thing. So straight away I was like, well, it looks pretty negative. A lot of things are down. I assume the decrease in margins would be a negative, but maybe that was expected. And the way to know if it was expected is simply the market reaction, and probably not expected. Although it could, or the share price could also be lower because of any sort of outlook. Another thing I like to look at is their capital expenditure. Here it is. So this is a cash reserves movement. So why has the cash gone from 219 million to 172 million? Nice operating cash flow, 774 million. Debt, they've increased their debt 370 million. And one of the reasons they've increased the debt is because of capital expenditure. So I do like this. I'll give Beach Energy some credit here. So when you talk about capital expenditure, there's two types of capital expenditure. There's growth capital expenditure and there's capital expenditure for sustaining operations. They can be quite distinct from each other, and they are distinct. And I do like when companies break it down because they're important. And Beach Energy have broken it down here. So sustaining capital expenditure is 594 million. And growth capital expenditure is 499 million. So they spent a lot of money this year on capital expenditure, which is, for this type of company, is probably not that surprising. In fact, $1.1 billion in capital expenditure. Half of that is for growth. In fact, I've mentioned I'm not a biggest fan of Phil Town, but he actually, one podcast I did listen to him many, many years ago, if a company doesn't reveal how they've divvied up their capital expenditure into growth or maintenance, then just assume it's 50-50. So you could have done that with Beach and been sort of near the mark. Anyway, so overall, I had a look at these results and I was like, nah, yeah, there's nothing that drew me in. And then I had a look at the share price on the market reaction. I went, yeah, it's pretty negative. Well, the market reaction is negative. So let's have a look at the chart for Beach Energy. And I could assume right now, hasn't popped up on my radar recently, and the chart looks ugly. But is there value here? Share price has dropped from $1.90 in April down $1.24. So is there any value in this company? What I do when I think there might be value, just might, I look at the longer term chart. So this is a weekly chart going back to 2018. So the lows we have seen from COVID-19, we have seen the share price get as low as about $1 back during the COVID-19 financial panic, nearly $1 back in September 2021, and some of the other lows have been around about $1.12, $1.20, $1.30. So the share price is getting to not quite to support levels, but it is moving in that direction. So it is moving towards possible value territory. So that's probably the only silver lining behind Beach Energy right now. It is falling to possible good value, maybe cheap. You might even say cheap. And now, so that's Beach Energy. In saying that, I have no interest in this company just yet. I might take a position if I do or am confident it is cheap. Okay, let's move on to the other company that saw the share price down today, and I almost took a position in this company. I'm glad I didn't, because the $3.33 when I thought, and I'll talk about why. Share price is down 9%. The company, again, just like Beach, released a lot of information. So the results didn't look that bad. I thought, okay, the results don't look that bad. So nice increase. Let's have a look at there. You'll have a look at this one. So revenue up 9%, EBITDA up 14%, EBIT up 20%, profit up 11%, statutory profit up 25%, free cash flow up 123%, earnings per share up 11%, return on invested capital up to 8.9, so not quite 10. I want that to be at least 10, but I don't consider this company, would never consider Aurizon to be a high quality company. So honestly, I would not even look at a return on invested capital, return on equity for this company, but it has risen to 8.9. Net debt to EBITDA down from 3.5 times to 3. Dividend per share to 17 cents. I did hear someone say they were disappointed with the dividend. So maybe that's why. I don't know. And they've also announced an on-market buyback of up to 150 million. So that means or implies the management think this company is cheap. That's the only rationalization behind doing a buyback, is if the management believe the company is cheap. If the company is not cheap, or if they don't think it's cheap, then that's a terrible capital allocation decision. Okay, so I thought the numbers were looking pretty good. Okay for this type of company. Now, profit, was it 406 million? Okay, so where's the earnings per share? 22.1. So current share price is $3.29. So we're talking about a P/E ratio of approximately 15 or just below 15. Now, I probably would assume that might be okay within the normal range. And you can check that if you really want to. Not trading view, FinChat. By the way, pretty sure I've never owned this company. AZJ. I've typed in AZJ. Hello, FinChat. Anyone home? There we go. So what you can do, just to know whether this company is cheap, just based off the P/E ratio, it's very simplistic, is just to have a look at the P/E ratio history of this company. And unfortunately, we saw a massive increase in P/E ratio and decrease in 2017 to 18. Let's just have a look at the last 5 years to cut out that period. Let's go back to 2020. There we go. P/E ratio of this company has been as low as 11 back in 2021. There you go. So it's not cheap based off this. But in saying all that, and the other thing is, I didn't have a look at any sort of guidance from Beach Energy or Aurizon. I'm just going to have a quick look to see if they have any guidance. So they do have an outlook, and they are expecting a little bit of growth in EBITDA. So maybe a 5% growth in EBITDA. I wouldn't expect massive growth for this type of company. For those who don't know, this is like a what do you call it? A transport company of coal. They own rail lines, that sort of thing, and they transport coal, agriculture. In one of their presentations, they do have the map of all their assets. Is that what do you call it? Their rail lines, I suppose. I'm just going to open up the presentation just to see if they do have it in this. Just take your time, Comsec. It's okay. Here it is. Somewhere here, I'm pretty sure. So coal, bulk, network. No, that's not it. They did have a nice map somewhere. And I just have no idea where it is. Anyway, so debt. Well, how much debt do they have? They have $5 billion of debt. So that could be an issue, but I don't know. Don't know. Okay, so why did I almost take a position in this company? Let's have a look at the chart. It's only because of the chart, nothing else. So if we have a look at Aurizon's weekly chart over the past 10 years, that's exactly 10 years here. Share price, whenever the share price falls below 340, that's a time to buy. So it fell to 340, or just below 340 in 2016, February 2016, during the COVID-19 financial panic. Also in November 2021, March 2023, It also hit 340 in October 2023, and now it's $3.29. So when this little purple box, that's a nice support zone for this company. So buying around about 3-4, anywhere between 320 and 340 is sort of a low risk buy for this company, because if the share price falls below 320, that would be an immediate sell, and then you'd hope for a nice little bounce. And last time the share price bounced off 340, it went to $4.10. So that's a nice little, almost 20% gain in a fairly short period of time. Anyway, so that's probably why I was thinking about taking a position in this company, just because of where the share price is. And the other reason is because last time the share price got to these levels, so this was in February 2023, I thought the same thing. I went, oh, this could be a nice little buy. And I went, no, the company sucks. But the share price bounced from $3.30 all the way up to $4, which is a nice, that's exactly a nice 20% return if you sell near the top. In fact, there's a clear signal to sell when the share price gets to about $4. Anyway, so that's the only reason I was interested in Aurizon, but the share price is down 9%, so the market doesn't like it. And when the market doesn't like it, I'm not sure. And yeah, anyway, so that's Aurizon. Coming in at number 4. Coming in at number 3, we have R Group. Share price up 4.9%. 1 year ago, almost to the day, share price for Car Group broke out on their financial results. And I kicked myself for about 6 months because the share price went on a nice little tear. And this is not a breakout. Share price up 5%. Really nice results from the company. And I'll tell you why it's not a breakout. It's pretty nice results from the company. One of the reasons I didn't like this company a few years ago was the lack of growth. Now, they were growing, but I open up the presentation. You get to see that the growth of this company has really accelerated the last few years. And I don't think this company is all that expensive based off the growth. Okay, so I'm hoping I can say, so let's have a look at some of the numbers here. So everything's positive by over 10%. So revenue in Australian dollars up 17%, EBITDA up 17%. They've also got adjusted numbers and reported numbers. I'll do pro forma because pro forma is it's like what the numbers would look if you didn't do an acquisition or didn't sell something. So what do they define a pro forma as? All information is presented. Pro forma NPAT, wait. Pro forma financial information assumes consolidation of Trader, Interactive, and Web Motors in financial year 24 and prior periods. So it's like if you made an acquisition during the year, what would your numbers look like last year if you made the acquisition 1 year ago or something like that? Anyway, so this tries to exclude acquisitions or something like that, or include acquisitions over the last 2 years or something like that. Anyway, hoping that makes sense. So their reported profits down 61%. So again, profit can be manipulated. So if you're just looking at profit for this company, their reported profit, you'd be screaming, down 61%. I am going to run for the hills, sell all my stocks. Oh, that's terrible. But adjusted profit up 24%, and pro forma profit, or EBITDA, is up 17%. Okay. This company has a lot of, a lot of assets around the world, or brands around the world. I didn't realize it was so many. So car sales, they also have boat sales, bike sales in Australia, Red Book Inspect, construction sales, caravan camping sales, but also in the United States, Trader Interactive, and a fair few other assets there, or brands. Brazil, and that's definitely Brazil. For some reason, that looks like Texas. It's definitely not Texas. Chile. I'd say it's Chile. And that looks like Hong Kong. Not Hong Kong, Korea. South Korea. I know. This company is really diversified globally. Oh, this is what I want to talk about. So if you go back 2 years ago, I wasn't that impressed with this company's growth. This is earnings per share. 7% growth, compound annual growth rate in earnings per share. That's pretty mediocre for this type of growth company. And all of a sudden, the growth has accelerated the last few years. It's now up to 16% per year. So nice acceleration in earnings per share. So I do think, well, maybe not do think, I have a much higher opinion of this company right now than I did 2 or 3 years ago because of this growth. And some of that growth could be because of acquisitions. Not could be, probably is because of acquisitions. So they also go through all their brands and I think geographical areas, go through their market leadership. So funnily enough, car sales has it's probably the and only one brand in Australia, but even in North Korea or South Korea, that has or very similar than car sales, and even their Trader Interactive is 3 times. I'm sure this is how they measure this. 3 times bigger than their next competitor. So that's pretty good market leadership. And I'm pretty sure somewhere in here they break down their performance in geographical areas. They should. I'm pretty sure they do somewhere. And they also have a where is it? Financial outlook, expecting pretty good growth, if I remember correctly. And let's keep going down this. I'm just looking for breakdown. Here it is, breakdown. Segment performance. So they've called this segment performance. I'd call this geographical performance. And really nice growth throughout the world. In fact, even Australia is their biggest market, I would suggest and probably argue that eventually North America, maybe even Latin America, will overtake Australia, maybe within the next 3 to 5 years. So I do like the diversification and I do like the geographical spread of Car Group. So I actually like this company a little bit more than I did even last year. Anyway, so that's Car Group. Now, probably the only thing I don't like about Car Group is the chart. Now, the chart's not bad. Now, I'm going to go back to last year. So here it is. There it is. We'll have a look at the daily chart. So there is. There's a breakout. That was on the 14th of August when the company released their results. The share price was in a nice little uptrend. And then the share price on this particular day rose 6.99%. And I was thinking about taking a position, but I never did. And over the next 6 months, share price went from $26 up to $37. A nice little return, not quite 50%, but it's a nice return over a 6-month period. This also backs up my research that I did a few years ago, that when a company releases a good result or a profit upgrade, the benefits could last 6 months or 6 to 9 months. This actually shows cases that, because the share price went on a rally for about 6 months and the share price peak was in February, 6 months after they released the results. And since February, share price has done nothing. In fact, it has gone down, moved into a very slight uptrend, and this is not a breakout because the share price was higher than this just a few months ago. In fact, 1 month ago, it was higher than where the share price is right now. So the question becomes, I wouldn't trade this right now because it's not a breakout, but is this a potential longer term buy? That's where I'm moving towards right now. This could be a nice high quality company on the ASX that you just buy for the long term because of the possible growth this company might experience over the next 5, 10, even longer years. Okay, so that's Car Group coming in at number 3. Actinogen. This is another reason why I sort of have not given up, but I've decided not to trade these type of companies. Day trading. Actinogen is one of those companies I was trading. And if I was in this company before this result, or even after results, I'm down 60% just on this phase 2 trial. Okay, so the title of this phase 2 trial, Actinogen Zana SID phase 2A trial top line results. If you look at the heading, you might think these results are pretty good. So Actinogen announces achievement of clinically and statistically significant superiority. So that sounds really, really good. Of Xanamem over placebo on depression in Xanacid phase 2A trial without, this is the kicker, without meeting the primary endpoint of a cognition attention composite. And in the next paragraph, that's one about clinically meaningful and persistent improvement in depression. The primary endpoint of superiority to placebo in a cognitive attention composite of 3 Cogstate computerized tests was not met. Not met, with a large improvement seen in both Xanamem and placebo groups. That means, I'm pretty sure this was a double-blind trial, that those who took the placebo thought they were getting the bait drug and they went sort of like the placebo effect. Oh, I'm getting this drug. It looks like a legitimate drug. I'm feeling better. I'm feeling less depressed. Now, what I did find interesting, so market doesn't like it. What I did find interesting, so there was effect, but there was also effect of the placebo people. What I did find interesting in there here, now I'm going to have to find it now. This is what I found interesting. So there was a significant effect, or a good effect, an improved effect for Xanamem and placebo. But this was a 10-week trial. And from week 6 to week 10, the placebo effect started to decrease, but the Xanamem effects kept on increasing. So the 10-week mark, there was actually a bit of a difference between the placebo and this particular drug. So that would make me think that if they extended this trial, maybe for 20 weeks, maybe you could see a significant difference between this drug and the placebo. So this is one reason why I probably would not be running for the hills and selling all my stock in this company if I held shares. Another reason, this reminds me of another company called Demerix. So Demerix, chart looks okay. Yeah, looks pretty good. If you go look at Demerix, go back to 2020. Let's go all the way back to 2020. Share price at Demerix was on a massive tear. Share price went from about 10 cents all the way to 75 cents in a fairly short period of time. But then on the 14th of September 2020, share price of Demerix dropped 62.8%, just like Actinogen. This was fairly similar. This was looking at their drug, which I forgot what it was, comparing to placebo, and there was no noticeable difference between the results of the drug and the placebo, just like Actinogen. Now, there could be a few slight subtle differences between the two, but I would not be completely upset by these results from Actinogen. It's just one phase, one trial, and there was effects from the drug, but there was also effects from the placebo. So I wouldn't be massively upset. I suppose I would be with the share price down, but it's not the end of the road for Actinogen. Nowhere near. Let's have a look at the chart. And this is the problem with these sort of companies. When you have a look at the chart, share price had been an uptrend, broke out. When did it break out? In June. Share price in 3 consecutive days rallied hard, looked really good, and the share price is now back down to where it was before the start of this rally. Pretty big volume came through, but I still think this is not the end of the story for Actinogen. They also have a lot of other things in the pipeline, Alzheimer's disease stuff as well. Okay, so that's coming in number 2 with Actinogen. Oh, this video has gone on way longer than I expected. So coming in number 2, or number 1, we have JB Hi-Fi. Up 7.97%. I did a tweet on this, and I had a bit of a dig at Ausbiz, the core guests or presenters, whatever you want to call them, because over the past 2 or 3 months, we have seen so many sell announcements or sell calls on this company. It's just one after the other. No, JB Hi-Fi, let's sell. JB Hi-Fi, sell, sell, sell. One person's actually said, don't want to call it a sell because I might look silly. Well, today is the day where all those presenters who call JB Hi-Fi a sell look a little bit silly, because not only is the share price up 8% on the release of the results, the share price is at an all-time high. The company also announced an acquisition today. Now, if you just look at the underlying numbers, you might think, why is the share price up? So, sales flat, 9.6 billion. Profit down from 525 million to 439 million. Oh, that's terrible. In fact, if you look at the profit last 4 or 5 years, this is the lowest profit the company has seen since financial year 20. Earnings per share down to $4.01, which means at a share price of 72 cents, the P/E ratio of this company is actually 18, which actually is high. By the way, it is high. Anyway, so the numbers don't look that crash hot. However, they did release a trading update. Do they say the trading update here? Trading performance. Well, they also made an acquisition, a company called ENS Trading Co. Premium offering across the kitchen, laundry, and bathroom product segments. Revenue of 230 million and EBITDA of about $7 million. So it's a fairly small company in the scheme of things, but it's an acquisition. And they say it's highly complementary to the group's existing brands. I suppose it is. Suppose it is. The other thing was the operating update, capital management. I love when companies do any sort of capital management update. I really like that. Talking about dividends, buybacks. Are they doing a buyback? Probably not. Special dividend. I could maybe argue, do they really need a special dividend? Generating sustainable long-term growth, that sort of thing. And here is the trading update. Now, I actually had a look at the presentation, not the media release. Trading update looks pretty good. I think one of the reasons why the share price has rallied today is because of this trading update. Now, it's a fairly short period of time. We're talking about 1 month. So from the start of the financial year to the 31st of July. But total sales at JB Hi-Fi Australia up 5.2%. That's comparable sales. The JB Hi-Fi New Zealand up 12.2%, but comparable down 4.9%. Now, the economy in New Zealand is significantly weaker than Australia right now, if I'm led to believe. So that's not a surprise, but they are increasing stores in New Zealand. Good Guys, which I probably would have been a little bit more concerned about, the Good Guys performance has really been worse than JB Hi-Fi Australia. But the sales growth for Good Guys up 2.7%. So July, or the start of financial year 25, has been pretty good for JB Hi-Fi. And even the CEO says it is pleasing to see sales momentum in Australia continue into July. Okay, so let's have a look at the chart of the JB Hi-Fi. No reason to even think about selling this company right now. That's just my opinion. A beautiful looking chart, in fact. Beautiful looking chart. And in fact, this is a breakout. I'm calling this a breakout. My only concern would be the valuation. A PE ratio of 18 does seem a little bit rich for this company, but I think I've mentioned that in the video I did on JB Hi-Fi not that long ago. But the chart looks really good. And this chart and what's happened today with JB Hi-Fi has made some of those experts look like, well, I'm being a little bit unfair, but putting sell calls out for JB Hi-Fi is fraught with danger. And this has been true over the past 15 years. And I've probably told the story multiple times. First time I bought JB Hi-Fi, the share price was something like $8, and it was the most shorted stock on the ASX. $8. Share price of this company is now almost $80. So the experts, the shorters, can get it wrong at times. So good day for JB Hi-Fi. And because this video has been going for nearly 1 hour, I'm going to end it there. I've talked about all the companies I wanted to. Didn't look at any charts. I suppose I did look at charts like this one. The only thing I didn't do was talk about any of your comments. Yes, anyway. Yeah, that's all I have for today's video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.